Okay, this mock exercise, we're going to deal with transfer pricing, and we're going to take a look at a case called ED Electronics. But before we go to the actual meat of the case, let's understand the rules of transfer pricing that we saw in class. So this is from your lecture notes. So I wanted to highlight the calculation of what is the appropriate transfer price that a typical company would set between other companies related to the same group of controlled companies to determine what is the acceptable prices that's going to achieve a win-win for both parties. So it's a win from the seller's perspective, it's a win from a buyer's perspective, and the third party is the overall corporate objectives. So corporately, it's called what we call goal congruency. So when we calculate transfer price, we always want to look at a range of transfer price which is acceptable to all parties. So the transfer price should be set, okay, as variable cost per unit plus the total contribution margin on lost sales divided by the number of units transferred. The second part of this formula only kicks in if we are operating at capacity or if the number of units ordered exceeds the manufacturing capacity. So that's the key. So if we are operating under capacity, so let's say the company, the manufacturing has 20,000 units that they can produce in a given month, and we're right now at 15,000, and then an actual internal order comes in for 2. That means 15,000 plus 2,000 units of the internal order would mean that we're still operating at below capacity. The capacity is 20, and if we include the internal order, we're at 17,000. In that case, this number, part of the formula, will be 0. So that means that the minimum transfer price should be at least variable cost. Now this is from the seller's perspective. From the buying's perspective, the buyer's division's perspective, the most that they'll ever pay is the cost of buying from an outside supplier. So that's actually the maximum, the threshold. Okay, so the buying company is not going to pay more for what they can buy it for in an outside supplier. So now you've got a range. The range, the maximum is going to be the market price, and the minimum is going to be the variable cost. And when we have that scenario, depending on each manager's negotiating skills, the range of transfer price, that will be a win-win for both the buyer and the selling perspective will be in the range from variable cost to market price. Now, if an outside supplier does not exist, the highest acceptable transfer price, so in other words, if there's no actual third-party verifiable market price, then we're going to set the maximum to be equal to the profit to be earned per unit, not including the transfer price. So in other words, you want to put the variable cost plus the actual profit that's going to be generated from that sale. So as a general guideline, we're going to solve this company called ED Electronics. We're going to take a look at the general guideline that says we want to set maximum transfer price and maximum at market price, minimum at variable cost. It depends on whether the supplying division has idle capacity or not. If they don't have idle capacity, then chances are the minimum transfer price will be the market value of the product. If the supplying division has enough excess capacity to fill the order, then the formula will yield a number just equal to the incremental cost. Now, incremental cost says variable in there, but it may not be completely variable. It could be some fixed in there. So, for example, if you accept this additional order from an internal division, you might have to incur, let's say, you might have to buy machinery that's important as part of the manufacturing process. that would be considered incremental cost, even though we would label that as fixed cost. Okay, so that's the minimum, that's the formula that we're going to use. Okay, let's take a look at the question. So you've got a question here. It's called ED operates as a decentralized corporation, and the bit division manufactures an electronic device. So let me enlarge that so that we can get a better view. So they have an electronic device and purchases a component X22 from the parts division of the same company. The divisional managers have full authority on the decisions involving transactions with internal and external customers and supplier. That's in essence the definition of a decentralized corporation. And we saw in our lecture notes that this is just one way to organize a company. Some companies, they decide to organize in a centralized way, which means that decisions in the way these divisions operate are done by the corporate head office. So again, there are many different styles of organizational structure, and this happens to be an example of a decentralized organizational structure. Currently, the parts division is operating at full capacity. That's important to note. And the bit division is operating below its capacity of 5,000 units. So the bit division, who's a supplier, is the parts division is operating at full, and the bit division, which is the buying division, has a excess capacity or extra capacity to produce at 5,000 units. Parts 22 can be sold externally for 75. That would be the market value. Let's label that. And the cost of producing the electronic device, excluding the cost of parts X22, is as follows. So they gave us the actual per unit cost to manufacture X22. And notice how the information is given to you. And of course, we need to know what is variable or what is fixed. So obviously, this is variable, variable, variable cost. And of course, this is fixed cost. Now, the manager of the bit division has received an offer from the national distributor willing to buy 500 electronic devices at $425. Okay, so indicate the maximum number transfer price that the manager of the parts division would agree to. So justify your answer. That's the first part of the question. So let's answer that one. So the parts division is operating at full capacity. Therefore, the minimum transfer price, I'll just short form as TP, that they would be willing to accept is the market price, which is 75. Because they would be indifferent, wouldn't they? They would be indifferent whether they sell it internally or not, because they're still going to generate the same amount of profit. So that's the answer for part 1, or part A. Part B says, indicate the maximum transfer price that the manager of the bit division would be willing to pay for parts X22. Okay, so this would be the buying company, right? The buying company. So the maximum transfer price should be $75. Now, if transfer price is greater than $75, then the manager would be better off buying it from an outside party. So buy external. Buy externally. That makes sense, right? So why would you pay more if you can buy it externally for $75? In addition, with a transfer price of $75, the incremental cost of each device would be $350, which is less than the $425. Now, so we've got direct materials, $120, direct labor, $30, and variable overhead is $125. So this gives us $275 plus the part X22 at 75, which gives us $350. So that would be the cost to produce the device. Okay, and what was the sales price of this device? $425, right? So, and then the sales price is $425, which is much less than that. Okay? Now, clearly the fixed cost is not relevant in this case, because if you add the fixed cost, okay, so if we add fixed cost of $100, then total cost is $450. And therefore, the company would result in a loss. But you really can't look at the fixed cost, because fixed cost is irrelevant in this case. Irrespective of whether we buy internally or not, they're going to incur that fixed cost anyway, so it becomes irrelevant in the transfer pricing decision. So in this case, the maximum would actually be $75. They're not going to pay any more than $75 because they can buy externally, and the overall profit is going to be the difference between $425 and $350. So profit will be $75 per unit. Okay? Now, part C says, assume the full cost of part X22 is $50. Explain whether the firm as a whole would benefit if part X22 is transferred from the parts division to the bit division at full cost. Justify your answer. So for part C, we need to understand what's the overall impact. Now, because the parts division is operating at full capacity, it can sell, and the fact that it can sell, and the fact that it can sell X22 at $75. In this case, the bit division will have to buy X22 on the market at the same price. So the company would really be indifferent, right, if between the two possibilities. Okay, so whether they buy outside or inside, the company is not going to matter. It's not going to make a difference, because at full capacity, they're going to have to sell it for $75 anyway. Okay, so assume that the cost is part $50. Explain whether the firm as a whole would benefit if part X22 is transferred from the part division to the bit division at full cost. Well, in this case, the company would be indifferent between the two possibilities, whether they transfer at full cost or at 75. The overall profit is going to be the same for the overall if you added two companies together. Now, the last part says, explain whether your answer in C would be indifferent if the part is not operating at full capacity. So this is part D. And the answer, if part division is operating at less than full capacity, what would happen? It would be beneficial for the company to transfer at full cost. If the transfer is not taking place, then the parts division would not be able to sell the 500 units on the market, and the bit division would have to buy them externally at $75 per unit, which is greater than the $50 cost, and even greater than the variable cost. which are only relevant in this case. So to answer this question is, yes, it would make sense, right? It would make sense to buy it at cost because overall the company would keep the profits. Okay, so operate at less than full capacity, then yes, it would be beneficial to transfer at full cost of $50, which is less than the market value of $75. So clearly the profit stays within the company, and given the fact that the bit division already has an actual buyer for 500 units, means that we can sell it to them and we can keep the profits on that as well. Okay? Thank you.